You're at the coffee shop. You need your morning fuel. You walk up to the counter. The person takes your order. Then comes the moment of truth. Payment. You don't dig for wrinkled bills. You don't search for coins. You just pull out your phone. You pull out your card. Tap. Beep. Done. You have your coffee. Easy, right? It feels like magic. But what just happened? Where did the money go? It feels simple, but it's not. This isn't just about convenience. This is a whole new system, a system with layers. Think of it like a stack. Each layer does something different, and each layer is controlled by someone. So when you tap to pay, you're not just buying coffee, you're plugging into a giant invisible machine. This machine is the cashless stack. It's a fancy term for all the pieces that make digital money work. Okay, so what is this cashless stack? Imagine you're building something with Legos. Start with a base, add bricks on top, one layer at a time. The cashless system is just like that. It has 5 main layers. Bottom layer, the one you see every day. This is the digital payment layer. It's your tap-to-pay card. It's Apple Pay on your phone. It's scanning a QR code at a market stall. It's the button you click to buy something online. This is the action, the part that feels easy and quick. It's the shiny, user-friendly surface, designed to be smooth so you don't think about what's underneath. Right above that, layer 2, digital identity. This layer is all about proving you are you. If you're not using cash, the system needs to know who is paying. This is where KYC comes in, showing ID to open a bank account or payment app. Phone scanning your face or your fingerprint, your phone's unique device ID too. This layer links your digital money to your real-world identity, like a security guard checking IDs. Layer 3, programmable money. Now it gets interesting and a little scary. Programmable money, digital cash with rules attached. Imagine your boss pays you, but that money can only be spent on certain things. Or imagine your money has an expiration date, like a carton of milk. The fourth layer is the data layer. Every time you tap, scan, or click, you create a tiny piece of data. Tap, scan, click. Where you were, what time it was, what you bought, how much you spent. All these tiny pieces are collected and stored. This data layer is like a giant diary of your life, written by your spending habits. Companies use this data to build a profile of you. They want to know what you like, so they can sell you more stuff. Banks use it to give you a risk score. Governments can use it to see patterns in society. This layer turns your daily life into valuable information for a lot of powerful people. So, why is this happening now? Why does it feel like cash is disappearing faster than free pizza at a party? It's not one single thing. It's a perfect storm of a few big reasons. The first and most obvious reason is convenience. Nobody enjoys fumbling for exact change while a line of impatient people stares at the back of your head. Tapping a card is just faster. Sending money to a friend through an app is easier than finding an ATM and handing them cash. We are creatures of comfort. We will almost always choose the easier path. And right now, the digital path is being paved with gold to make it as easy as possible. Another huge reason is cost. Printing bills costs money. Minting coins costs money. Moving that cash around in armored trucks costs money. Storing it safely in vaults costs money. Counting it at the end of the day costs of business time and money. For banks, governments, and big companies, cash is expensive and inefficient. Digital payments, once the system is built, can be much cheaper to manage. Then there's the big one, information. We talked about the data layer. That data is incredibly valuable. Finally, the technology is just ready. Every big change creates winners and losers. The shift to a cashless world is no different. So who's popping the champagne? First in line are the big payment companies. Think Visa, MasterCard, American Express. These guys run the rails we talked about. They are like the owners of the highways that money travels on. Every time you tap your card, They take a tiny little toll, a small percentage of your purchase. It might be just a few cents, but when you multiply that by billions of transactions all over the world, every single day, well, you can do the math. They are making a fortune just by sitting in the middle and moving money from point A to point B. Next up, we have the tech giants, companies like Apple, Google, and Amazon. They aren't just making phones and selling books anymore. They are getting deep into the money game. Apple Pay, Google Wallet, turn your phone into a credit card. They build the slick, easy-to-use apps that make you want to go cashless. Why? Because it keeps you locked into their ecosystem. They also get access to all that lovely data about what you're buying, and they can use their app stores to control which payment apps you can even use. It's all about power and control. Of course, the banks are big winners too. For them, cash is a headache. It's expensive to handle, store, and secure. Digital transactions are just numbers on a screen. Much cheaper, much cleaner. Banks also get to create their own payment apps and services, competing with the tech giants. They get to collect fees on transfers and accounts. And just like everyone else, they get a front row seat to your spending habits. This data helps them decide if you're a good candidate for a loan, a mortgage, or a new credit card. In a cashless world, banks become even more central to your financial life. This all sounds very efficient, doesn't it? A smooth, digital world where money flows like water. But what happens when the tap gets turned off? What can go wrong? Well, a lot. The most immediate problem is exclusion. What about people who don't have a bank account or a smartphone? What about the elderly who might not be comfortable with new technology? Or people living in rural areas with bad internet? A fully cashless society risks leaving these people behind. If the corner store only takes digital payments, and you only have cash, you can't buy a loaf of bread. You are locked out of the economy. It creates a new kind of poverty, digital poverty. Then there's the risk of system failure. Technology is great until it isn't. We've all had our internet go down. We've all seen an app crash. Now imagine the entire payment network for a city or even a country goes offline. A technical glitch, a power outage, a cyber attack. Suddenly, nobody can buy anything. Not gas for your car, not food for your family, nothing. You might have thousands of dollars in your account, but it's completely useless. Cash works even when the power is out. It's a reliable backup. In a 100% digital world, we lose that safety net. We become completely dependent on complex systems that can and do fail. One of the biggest worries is the loss of privacy. As we said, every digital payment creates a data point. This creates a detailed record of your life, who you meet, where you go, what you buy, what you believe in. Do you donate to a certain political party? Do you visit a specific type of doctor? In a cashless world, this information is collected and stored by banks and tech companies. It can be sold to advertisers. It can be hacked by criminals. And it can be demanded by governments. This creates the potential for mass surveillance on a scale we've never seen before. Your financial life is no longer private. It's an open book. Let's go back to that idea of rails. It's a simple way to think about the invisible networks that move our money around. Just like a train needs tracks to get from one city to another, your money needs rails to get from your bank account to the store's bank account. And whoever owns the tracks decides how the trains run. The most famous rails are the big card networks, Visa, MasterCard. They are global giants. They have built a system that works almost everywhere. When you use their card, you're using their private rails. They set the rules, and they collect a fee for the ride. They have immense power because their network is so vast. But those aren't the only rails in town. Banks have their own systems for transferring money, like wire transfers or ACH in the United States. These are another set of rails. Then you have the new players, the fintech companies and tech giants. Think about PayPal, Venmo, Uber, in-app payment, WeChat, in-app payment. These are often closed-loop systems. They build their own private railroad. Money moves around easily inside their world, but it might be harder or more expensive to send it outside their network. They want to keep you and your money on their tracks, because that's where they have the most control and make the most profit. So why does this matter to you? Because a lack of competition is dangerous. If everyone is forced to use only one or two sets of rails, the owners of those rails have a monopoly. They can raise their fees as high as they want. They can change the rules whenever they want. They can decide who gets to use their service and who gets kicked off. This is why having options is so important for freedom. When there are many different rails, card networks, bank transfers, open source crypto networks, local payment apps, it creates competition. If one network becomes too expensive or too controlling, people can switch to another one. This keeps everyone honest. It forces companies to offer better service at lower prices. It prevents any single entity from becoming a financial dictator. The diversity of the rails is a measure of the health and freedom of the financial system. The more paths your money can take, the more power you have as a consumer and a citizen. Okay, so the digital money machine is big and powerful. It can feel like you have no choice, but you do. You are not helpless. You can take simple, practical steps to keep your freedom and stay functional in this new world. The first and most important is this: don't abandon cash completely. Think of cash as your financial emergency kit. It works when the power is out. It's private. It can't be turned off by a company in another country. Keep some on hand. Use it from time to time. By using cash, you help keep it alive as a viable option for everyone. It's a small act of independence. Second, diversify your digital options. Don't put all your eggs in one basket. Don't rely on just one bank. Don't rely on just one card. Don't rely on just one payment app. Have a few different ways to pay. Maybe you have a card from a traditional bank, an account with an online fintech company, a PayPal account. This way, if one system fails or an account gets frozen for some reason, you're not completely stuck. You have backups. It's the same reason you have a spare tire in your car. You hope you never need it, but you're glad it's there when you do. This gives you resilience.